Hey everyone, it's Gary. Hope you all are doing well. Hang on just a second here. Just want to get to where I want to be in this email. First off, welcome everyone to this week's live investor agent webinar, and also for everyone else in the flipping program, buying rentals, managing rentals, and wholesaling. Welcome aboard to all of you. We're going to get started here in just a second. We are live and we are recording right now. So in any case, open mic, you get to use your question box to type in questions. So let's just go over that a little bit here. Welcome to all the new folks, particularly in the last couple of weeks if you're from New Jersey. Should a lot of folks here from New Jersey, Georgia, the Carolinas, everywhere I've been in the last few months, Florida, pretty much all over. But in any case, you'll notice that you're in mute by default. That's that's by design from the system, of course, because we can't all be on talking at the same time. So you can use your question box. As a matter of fact, let me go ahead and put on the attendee box and see who we got here. Good, we got some veterans, and we got some brand new folks. So hey Shirley, are you going to the 3-day event next weekend? I think you mentioned that you were. I just don't know that you've registered or not. I don't know. I know you probably don't need a room because you could probably drive there every day. But let me know, or let Beverly know. We're a little bit over halfway to capacity. We're probably, let's see, what would this be? 5/8 capacity as of today. So we've got 5 more classes to go. So I think they capping this one off at like 40 people, something like that. But in any case, real quick, guys, let me just make sure everybody is okay on the technology end of things. So let me open up my chat box and type in the question. Can you see my screen and hear my voice? Okay, if you guys could please respond to that, just let me know. It looks like everything's okay on this end, but of course, we never like to assume things. So Cedric, let's see, looking forward to meeting you again in short notice. Awesome, excellent, Shirley. So Cedric, check your settings. It looks like everybody was okay, audio and visual. I'm not sure why you're not getting a screen. The screen that I have up now is actually an email. So let's see, I am showing my screen apparently. Let's see, no one can see my screen. How about that? Thanks, Cedric. Okay, now you should be able to see my screen. Okay, so let's go back here to the question box. All right, everybody saying yes now. Bingo, hot diggity dog. Okay, so real quick, for all the new folks, just a brief bit of housekeeping here. Always make sure you check the email the next day after a webinar, whether you've attended or not, to get the email from Beverly that has updates to the systems, updates to the material, updates to the schedule, and of course the upcoming webinar schedule and other vital information. So, and as well as the recording of the webinar. So some of you are listening to this live, and if you are, that means you got the webinar, or got the email, excuse me. So for everyone else, you know the drill. If you have questions, go ahead and type them in when you have, as they pop up. What I'm going to do tonight, unfortunately, I literally just got the email from Fassel before this saying he can't attend tonight in this webinar tonight. We're going to use to look at a property he's looking at. We're going to look at his numbers, and then we're going to bring up the opportunity evaluator, and we're going to look at those numbers there. Okay, and then we're going to use the rental property analyzer and do a different view there. Remember, the different calculators are there for different purposes. Some of them give you a snapshot in time view of the property, financially speaking. Others allow you to do projections. You know, what if you sold the thing in 5 years? They give you internal rate of returns, all these things. Don't worry about what all that stuff means right now, guys. I'm going to go through them one at a time and break down the calculators as we go through them to show you what they're showing you, so you can explain this to your clients, okay? Or if you're an investor yourself, obviously you want to use these on your own properties. So, but real quick, I just want to make sure I didn't miss any initial questions here. Okay, all right, I think everybody's okay. So let's go ahead and hop to it. What I'm gonna do is show you the property that's in question here. So let me scroll down here. and it is right here. I think that's this view right here. So let's click on this. It's obviously a photo of an MLS listing, so let's expand this a wee bit so everybody can see it. Okay. In fact, I'll expand it a little bit more, and I'll scroll as we go forward through the listing. Okay, so right away, we can see this. Let's see, 7 rooms, 3 bedrooms. The property, they're asking $339,000 for the property. Okay, it looks like it's got 2 units, so it's a duplex. Okay, so let's just go through this. Let's just look at this description of the property. Remarks: charming Victorian, 2-family in the heart of Hawthorne, 1st floor, living room, eating, kitchen, bath, shower, stall, 2 bedrooms. Hang on, guys, I got to turn my phone off. Hang on just 1 second. I forgot to do this. Okay, there we go. All right, 2 bedrooms and access, 2 basement, laundry, storage, 2nd floor, living room, large eating, kitchen, bedroom, full bath, walk up, attic to storage. Laundry room is in the basement with own hookups and entrance through the backyard, all utilities. Hey guys, instead of me having a picture jump around, I'm going to reduce my panel, so I'm not going to be able to see your comments for a moment or two while we go through the property. I just want to get the description down. You can see the picture right here is one black and white photo. Looks like a nice Victorian. Okay, now let's get to some of the details. It says basement's unfinished, but I guess they're using it obviously for laundry and storage and so forth. Level 1, 4 rooms. We've already saw this up top there, 2 bedrooms, 1 bath. 2nd floor is 1 bedroom, 1 bath. They're getting $14.15 for the 4 bedroom, which is downstairs, and they're getting upstairs $10.80 for that one. So a total of $24.95. Not too shabby. Okay. Let's see. Inclusions: electric range, or smoke detectors, carbon monoxide detectors, the usual stuff. All right, owner pays water, tenant pays electric, tenant pays gas, tenant pays heat. I'm okay with the owner paying water. You know, they just probably have 1 meter. It's just a duplex, and that's not a bad deal, not a big deal. However, if you're in a municipality, if you're in a water authority where it's easy to separate the water, I recommend doing it. Now, having said that, I want you to write this down, guys. In most municipalities, the water and sewage are lienable items. What that means is if they don't get paid, the municipality can put a lien on your property. So what I do is this: I want to pass on as many costs to the tenant as possible. Gas, electric, everything, including water when it makes sense. Back in the old days, water wasn't that expensive. Now water is quite expensive. So what we do is 2 approaches here. If you can separate the water at the municipal level, in other words, coming into the meters, so they have 2 meters to read, 1 for each unit. What I would do is I would never put the water in the tenant's name. And again, I said I'm going to have them be responsible for it. But the reason why you don't want to put the water in the tenant's name is some municipalities are kind of lax in their notifications. And if a tenant doesn't pay a water bill and they move out, you probably won't even know it till somebody else comes in, and then you got to get water in their name, or I'm sorry, you need to pay out the current account so that the new tenant starts off with 0. Or worse yet, you go to sell the property only to find out that the previous tenant hadn't paid the water bill the entire year they were there. So the workaround is this: we put the water in the owner's name, okay, and then we invoice the tenant for the payment of the water, and we put that in the lease. We write it into the lease, either in an addendum or an attachment, so it becomes part of the lease. And what that means is if they don't pay the water, you can evict them just as if they didn't pay rent. Okay, so let me do a quick pause here. Tonight we're going to go over calculations, but water always comes up. So let me just pause for a second and see if anybody has any questions on what I just described there, because it's an important concept. I can tell you from experience, you might go months and months. I've actually had a property years ago where I bought the property, and 6 years later, the water authority was moving offices, and they found an old water bill behind one of the file cabinets that happened to be for my property from like 13 years prior. They not only charged me to make me responsible to pay the bill, they also charged me interest and penalties. And I said, I don't think so. I just bought this house, 6 years ago. I didn't know it 13 years ago. And why didn't you bring this up when we did the title search on the property? And they said it's, purely accidental. It's nothing against me personally. The fact is water is a lienable item. The owner is always responsible for the water. And I said, I understand that, but the reason we do title searches is to uncover items like this. Whether it was an accident or a mistake or hidden under a file cabinet, it doesn't matter. I actually ended up winning. I didn't even have to go to court. I made my argument, told them I was going to get my attorney involved because I feel like this was a violation. I wasn't given the opportunity to make good on that at the time of the purchase. I was that opportunity. I was disenfranchised. And when I used that phrase and they went to their attorney, they said, you know what, just just wipe it off and don't make the guy pay it. In any case, long story short, always be on top of municipal items that are lienable, particularly water, sewage, even garbage. Okay. Now back to this. Another option is, by the way, internally inside the house, after the water authority's meter, you can split the water yourself and put your own meters on there. What that means though is that you got to go read those meters every single month, so you know what portion to charge the tenants. Okay, how to prorate that. That's a big pain in the butt. I'd rather just have it split from the authority and get 2 separate bills right off the bat. And again, back to this. So the tenants are paying gas and electric and heat. Sounds good. You've got a hot water radiator, so it's an old property. In fact, they probably tell us when this thing was built somewhere in here. Let's see if we can find that. I don't see the year built yet. Perhaps we'll find it down here. In any case, the taxes are $8,600 a year. Again, this is probably New Jersey. New Jersey has high taxes. The building's assessed at 70 grand. The land is assessed at 79, which means the property is assessed in total for 150. That's just for tax purposes. That doesn't mean it's an actual appraised value. It's just for tax purposes. In any case, that's the lowdown on that. So let's do this. Let's now switch over here and see fast those numbers on the property. Okay. So here we go. So we'll start at the beginning. Monthly income $14.15 per month. I thought it was $14.95, but that's okay. We're not going to split atoms here. No accounting for vacancies. Let's see, property management. There's no accounting for that. Okay. Let's see, repairs and maintenance, no accounting for that. We got real estate taxes, $720. Oh, they did this on a monthly basis. Okay, that's why. All right, property insurance, $100 a month. Utilities, $100 a month. That must be for the water. Nothing's held in reserve, and there's no homeowner dues. Okay, and you got legal and accounting. So monthly operating expenses is $970 a month. Now, obviously, I think that's a little. We need more meat and potatoes in that. So when we get to the, sorry, let me go back up here. When we get to the opportunity evaluator, we'll plug in some more of those numbers. Okay. But real quick, let's get back to where we were. So on an annual basis, you got net operating income. You take the 970, multiply it times 12. I'm sorry, that's your net operating expenses. If you take your NOI, which is 16,980, subtract from that your annual operating expenses, you end up with a net operating income NOI of 5340. Well, on a $340,000 property, right off the bat, I'm thinking that looks a little light. You've got a capitalization rate of 8%. In other words, properties are going up by 8% per year. That could be true because I'm in New Jersey right now, but I can tell you, just like in most other parts of the US and Canada, values are going through the roof, guys. I mean, very few areas are stagnant. They're just literally shooting up like a rocket. Which leads me to another subject altogether, which is what happens historically when things shoot up like a rocket like this. Yeah, when what goes up must go down, right? So in any case, the actual purchase price is $339. All right, that's what the people are asking for the property. I don't know that they'll get it. They might get it because of the way the economy is right now. We're assuming no down payment. In other words, this might be a VA purchase. So somebody who can get a VA, who has VA eligibility, doesn't have to put down a down payment. Okay. The cost of the purchase, the acquisition cost is about $2,500. That's the guesstimate there. Mortgage, you can either do 30 years or 10 years. We'll do the 30-year mortgage here, 4.25. Initial investment, $2,500. Monthly payment, $1,667 a month, which means you're spending $14,297 a year on interest, and principal you're paying down by $5,700 a year. All right, total annual debt service, $20,000. Well, right off the bat, we know we're in trouble. Okay, so let's continue to look at this property. All right, here we go. Monthly cash flow before taxes, negative $1,222. Annual cash flow before taxes, $14,672. Well, I don't think we got to worry about taxes on this one. In any case, this would have to be a special circumstance to buy this property. And without Faisal being on the line here, I don't want to go into what those details are. But for example, somebody could be buying this as an owner-occupied property where they live in one unit and rent out the other unit. Okay. But regardless, we should always look at this from both angles: the angle of the person living there and the angle of the person not living there, and what would happen if the owner moved out and rented out both units. So what I want to do now is see, I think Faisal gave us the opportunity evaluator filled in. He did. So let's look at that, but real quick, let me just bring the panel back over and look for questions. Okay. Oh, good. We got several of them. All right. So this is Floyd. Hey Floyd, how you doing? Will radiator hot water heat be affected by splitting water? Yeah. So when you split the water, Floyd, what happens is you've literally got the good news is if it's an up and down unit, which this is, all you do is you separate off everything on the first floor. Everything on the second floor stays with the original piping. On the first floor, you have access to everything underneath the floor from the basement. So I've done it before dozens of times. Not that difficult. Every now and then you run into some kind of coinky dink, and they've run a line in a series going up the walls and things like that. I've seen all kinds of crazy things. But the reality is that you leave whatever is there for this, have it feed the second floor. Anything that's for the first floor, you have to cut that off and resupply it with a new line from the new meter. That's really all we do. You just simply split off the first floor. If you've got side by side, actually it's just as easy, if not easier. But let's say you've got a 3 or a 4 floor building and a unit on each floor. That I wouldn't do. It's just too difficult. You've got to literally dig into walls, and it's just a big pain in the butt. It's just not worth it. Okay. So good question. Thank you. Let's see. By the way, Floyd is from Florida, guys. Okay. Let's see. This is from Tahira. Hi, Tahira. Gary, you didn't add the second apartment. That's just one of the units. So that's, that probably explains why the numbers are so low, because I guess this is intended to be an owner-occupant unit. There it is, 1415. Okay, so let's play with this to here. Let's add in. Let's use the opportunity evaluator, and we're going to act as if both units are going to be rented out. Okay. All right. Let's see. Daryl's asking, can you please share the cash flow analysis? Yeah. So I only thing I have, Daryl, from Faisal is what I've just showed you. But what I'm doing is we're going to do a cash flow analysis now. So let's do that. Let's see here. What's the okay? Gross rental profit is actually more than 16,980. So let's go ahead and let's just go ahead and do this, guys. Let's put some values in here. So 1450 for the first floor, and I think it was 1080 for the second floor. Let me turn on edit here. Okay, so 1080 for the second floor. 1080. Let's see if that doesn't help things a bit. And oops, that's not what I want to do. I'm going to take off a 0 here. Hang on 1 second. I was going to say that thing's looking pretty good now. All right, there we go. Wait, this shouldn't be. This should be number 1 here. It's a duplex. Let me change this 2 to a 1. Now we'll get some accurate figures. There we go. So total rent's 29,940. Let me just go back to the original picture just to make sure here. So let's just double check here. All right, 2 units, 14, 15 per month, 1080 per month. Yeah, 4 rooms, three rooms, 2 bathrooms. Sorry, 2 bedroom, 1 bedroom. Okay, so we're good there. We got the right rents in there. Now let's see what we got with the numbers. Okay, vacancy loss. Let's be a little more realistic here. Let's put in 2%. Now, I will tell you guys, across North America, vacancy rates are very low right now, all right? Occupancy is up through the roof. It's just amazing. We've got, we're in very heady times, but everything, again, nothing is permanent here. So right now we should have some dramatic improvements in numbers here. Let's go down and let's fill in some more figures here, all right? Property, so we got real estate taxes, we got property insurance. Let's just assume no management. That's okay. We'll just assume the buyer's going to manage himself. No payroll, maintenance of repairs. We definitely need to add something there. Okay, so let's put in 600 on an annual basis, 50 bucks per month, 25 bucks per month per unit. We're not paying gas, electric. We are paying water and sewage. Let's just leave that at 1,200. Accounting and legal, I'm not gonna, let's just say 50 bucks. How about that? I think that's what Fassel had. Okay, advertising. Let's say you have a vacancy. You might spend $50 on advertising there. Okay, now, how about lawn care? Let's assume the buyer's doing their own lawn care and their own snow removal and so forth and so on. Okay, so we're not going to have management cost, and we're not going to have the owner's going to do a lot of work themselves. The challenge is this: net operating income is 17.5, and annual debt service is 19,675. So regardless, in spite of our best efforts, we still got a negative cash flow. But let's do this. Let's go back to the top. So this is the way it stands now. All right. Let's just double check our figures. 339 purchase price. Initial investment 10 grand, which means for financing. Actually, this should be 3. Well, let's just keep that the same. All right. 12 payments, 4.1%, 30 years, and that's your monthly mortgage payment, 1638. All right. And we've got every month we got 20. What did we say that was? 1080 and 1400. Let me just double check here. 1495 per month. 1495 per month. Okay. So when I look at this, there's things we can do. Let's assume. Let's do this. Let's not change the mortgage. Actually, let's do that. Let's change the mortgage. Let's say we're going to put down about roughly 10%. So we're going to have a mortgage now of only 300,000. It's not going to make a big difference. Okay. But we now have to put in 49 grand. All right. Acquisition cost plus down payment. So the mortgage payment goes down a wee bit, but it's really not going to be enough to really help. I'm going to suggest that we raise the rent on this one, the bigger one, to 1,500. Okay. Let's raise the rent on this one to be 1,200. Okay. Let's see if that helps us. Just a little bit of adjustment there. We're already light on expenses, so we got to be careful. All right. We can even eliminate vacancy again, just to benefit of the doubt. So let's see what we end up with now. Now we're into the cash flow game. We've got a little bit of cash flow. Cap rate's up to 6.1%. Debt coverage ratio is 1.184. The challenge we're going to have here, guys, is this. Most lenders want to see minimum 1.2 debt coverage ratio. That's the portion of rents that are left available to pay for debt service after other known expenses like taxes, insurance, maintenance, and repairs. Okay. So that's a little low there, just by a wee bit, but it's a little bit low. And the cap rate is probably commensurate with the area. So cap rate's not that bad. Now the reality is according to this thing, this is saying the actual value right now, based on the numbers, is only $206,000. And this guy's wanting 339, right? That's what we know based on the opportunity evaluator. So we've done that. Let me go back to questions, and then what we're going to do is we're going to bring up the Rental Property Analyzer. It's one of my all-time favorites. This is the one that doesn't just give you a snapshot in time right now. It gives you a snapshot in time. I'm sorry, it gives you the, why is this doing this? Loan amount, loan term. This doesn't look right for some reason. Hang on one second. Yeah, Rental Property Reporter, Resource Analyzer. I might have to go back to the website and grab the one that I want because I'm not seeing, this doesn't look altogether correct. But in any case, let's go back to questions first before we move forward. Right, so first things first, I think we determined if this was fully rented, we could possibly barely make this work, okay? And we don't have any current questions, so that's good. Let's go back here. What I want to do is go to the website, guys, real quick. Just hang on one second. Make sure I've got the right calculator. My investment services, members area. So remember, all this stuff, guys, is on in the silver level members area of the website, okay? So if you go to myinvestmentservices.com, click on members area, log into the silver level, and go down to here for analysis forms and calculators, all right? We can see property inspection report, property rehab analysis, rental property calculator. Right here's the link to the online calculator. So let's see if this is the right one. Aha, that's the one I'm looking for. Right. So let's do this. Let's plug in current value. Let's plug in 339. We'll start with that. We may change this in a bit. Cash investment, I think we said we're going to put in 39,000. 39,000. Oops, that's a percentage. Sorry. Let me go back here real quick. I'm going to make this 39,000. It's going to make me put down a percentage. Let's just call it 10%. Okay, let's see what that comes out there. That's close enough. All right, now, so the mortgage is going to be 305,100. Let's make it 11% just for grins. That's more like it. Okay, mortgage rate, I think we said that was going to be 4.1. Okay, let's look at some assumptions here and make sure. So long-term, 360 a month. Purchase cost of percentage of sale price, I think we said it's going to be even 10,000. So 1% would be 3,390. I think Fassel said he was going to put in about 10 grand on acquisition costs. Let's make that 3%. Okay, so that's going to change things a little bit. When I talk to that guy, hang on one second. Let's see if we can get rid of that. Let's close that out. How do we close that out? Okay, I don't want to do that. I want to get out of this. Here we go. Sorry, guys. All right, back to this. Okay, monthly rent. So we've got $24.95 coming in. Right, everybody, hang in there. $24.95 cap rate. That's going to change because we're going to put in some other variables here. All right, vacancy rate we just said was going to be 0. And rent increases, let's assume, actually rent increases, I'm going to tell you guys, they're going up, all right? And they're going up quite a bit. So let's say 5% right now, okay? And that's probably going to be true for the foreseeable future. All right, property improvements. We're going to say 0 to get things initially ready for rent. Property management, we said, is going to be 0. Okay, maintenance, we said 600 per year. That's not going to be 1%. That's going to be more about let's see, 0.05 and see what that gives us. Okay. Okay, insurance costs. So let's make that 0.5. Sorry. Insurance costs, same thing. 0.5. Okay, move in, move out costs. That means when somebody moves, you're going to have people move in, move out. That's going to cost us $1,000. Paint, clean, carpet, advertise, the whole 9 yards. Okay. Now, let's say we're going to sell the property 5 years later. All right. We're going to have some selling costs. Let's say it's 6%. In fact, we should probably make it 10%. All right. Because you'll have commissions, transfer taxes, all kinds of stuff. Appreciation rate. I'm going to say it's going to be more than that. I mean, let's make that 5%. Okay. Again, things are going through the roof right now. It's probably more than that, but let's just keep it at 5. Value of the land. Let's say the land is going to be, let's make that 1%. Well, you know what? We better make that 10%. Okay. Total tax basis. So you take the purchase price of the property, subtract the value of the land, and you end up with your tax basis 305, right? All right, property tax rate. We're starting to get to the end, guys. And what I'll do is I'm going to fill all this in, so when we go over all of the results, it'll make a lot more sense. So property tax rate, let's say that's 3%. New Jersey's pretty high, but let's just keep it 3%. Let's assume the buyer's tax rate is around 25%. You know, let's make it 15%. Okay. Capital gains tax, let's keep up at 15%. Expected inflation rate. Right now, inflation's in check. Let's keep it there. Investment hurdle rate. So this is what this is, guys. This is what this calculator is using to compare against. So what that means is the owner, this buyer, could put their 39 grand in another investment and make 8%. We're now going to compare the results of this property against that 8%. Okay. We can make it 10 if you want. Matter of fact, let's do that. Let's call it 10%. Okay. It's usually a pretty good hurdle rate for most people. So let's check out some of our results here. All right. First thing is everything is done in projections. You got the initial year, the year that you purchased it. Then you got a year later, year after that, 5 years, all the way down the road. Projected cash flow. So this is what Daryl was asking about. At the end of the day, is going to be almost $58,000. So what you have to do is you take your cash flow of all the years, the 5 years plus the year you purchased it. You see it's negative that year, negative the full first year. You finally break positive in year 2, all the way up to year 5, where you make, you know, close to $100,000. But the net total, you gotta net out your losses in the first year or two. That means you've made $57,900,000 in cash flow. But there's more to the story than that. Okay. This is why I like this calculator, because even though something like in this one here, the rental property calculator might show us that this thing is slim pickings at best. It's a one-time snapshot. It's a what it looks like at this point in time. What we want to look at is not just right now. We want to look at the future, and that's what we're doing here. So let's just bring up the details. So this is first things first: cash flow and return on investment details. So take a look at that, guys. First, get yourself acquainted with the screen. Okay, we're going to go through it. So cash flow. When you first purchase it, you're negative, obviously $37,290. Okay, year 1, okay, you're still negative about $8,700, but you're doing better. And if you look at year 2, you're in the positive. Year 3, year 4, year 5, things tend to get better because of your annual rent increases. In year 5, you're making $4,400 a year, almost $4,500 a year. Okay. So if you add all those up and you net out the negatives, you end up with $2,080. All right. Let's say you sold the property. We're assuming, based on the appreciation rate we assigned, it's going to sell for $432 in 5 years. Selling costs are going to be 10% of that. This is your commission, your transfer taxes, all that kind of stuff. Okay. You've got a capital gain of 105 grand. So remember, the property depreciated over that 5-year period. So if you took the depreciated cost basis, add in your profit, your cost basis is now, I mean, your taxable gain is 105. You didn't realize that in cash. Remember, when you depreciate properties, your cost basis in this example went from 339 down to probably under 300,000, or somewhere south of 339. That's what that means. So at a 50% tax rate, you got to pay 22 grand on that capital gain. All right. So you got a note to pay off. You got to pay off the mortgage, $273,000 in fact. Okay. So at the end of the day, when you factor everything in, your net operating income, your cost of selling, the profit from the sale, the capital gains, taxes, you end up with 57 grand in your pocket. So essentially, you didn't even quite double your money in 5 years. You went from 39,000 to 58,000, roughly speaking, in about a 5-year period. Okay. So your return on investment, obviously negative the first year, and it starts to break positive. It goes up in the 5th year. And you average everything out, you're 5.6%. Okay. Your present value, okay, this is what this means is this is your cash flows discounted by that hurdle rate we talked about. So if you compare this with another investment earning 8%, if you do it, you basically discount it. And what you end up with is a real gain of 18,000. You made 18,000 more than if you had done the 8% investment. That's what that means. So the walkaway price to break even if you do sell this in 5 years is 357. You wouldn't want to sell this for less than say 357 to break even on a sale 5 years after you purchase it. That's what that is. We do a 5-year projection. Okay. Now, in any case, we got to look at some other factors here. So, sales price again, 432. If you sold it 5 years later, you got your selling cost. Your net cash proceeds is this 389, right? You took the 432 minus 43, you end up with 389. Your depreciated basis, right? Remember, you depreciated this property. That's your depreciated basis, 283. All right. So your taxable gain, if you subtract 283 from 389, you get 105 grand. That's how you calculate what you're going to actually pay taxes on. Okay. You've got to recapture the depreciation. That's, in other words, you depreciated 3.41% for 5 years. That's what depreciation is. When you recapture that, remember you got the use of that money for free. You're not going to pay taxes on it. Okay, and that's 8,300 bucks. Capital gains tax, 14 grand. The note payoff 273. At the end of the day, cash in your pocket 93,000 bucks. Now you see why we do this 5-year projection, because even though property might be negative cash flow today or not that great today, the fact is if you have a reasonable degree of confidence about the economy and you believe your property is going to appreciate at 5% per year, believe me, I know a lot of investors who will even take a negative cash flow current day with the anticipation that they're going to have a big payoff at the end of 5 years. Perfect example, San Francisco, California. People literally will buy a property with negative cash flow because they know in 5 years, so they have appreciation rates of 15% in some neighborhoods. I mean, on the total value of the property is going to double. So let's say you bought $1 million property in San Francisco, sold it 5 years later for $2 million, and yet when you bought it, you only put in, 20%, 200,000. Well, 200,000 in 5 years, you've turned into 1.2 million, right? 1 million minus 200,000 on the initial purchase, 200,000 being your down payment. The rest is financed. Okay, at the end of 5 years, you get 1.2 million out because you still have your $800,000 mortgage, give or take a few bucks, and you put 1.2 in your pocket. Who wouldn't want to take 2 million and turn 200,000, turn it into 1.2 million in 5 years? Okay. That's why people will buy properties with negative cash flow. So I always get frustrated when investors or agents will tell me this property doesn't work right now. It might not work right now, but look at what's happening in the economy. What's this thing going to look like in 5 years? And are you willing to take that, make that investment, and take that chance, take that risk? It's an educated risk when you do stuff like this. Okay. So real quick, I've got 3 more tables to go over, and we're already at 7:40 Eastern. So let me just double back here and check for questions. Okay, Tahira, Gary, you said most lenders want a debt coverage ratio of what percent? What does DCR stand for? So DCR stands for debt coverage ratio. It's the portion of income, Tahira, after your expenses like taxes, insurance, um, maintenance and repairs that's left available to pay any debt service, which is your mortgage payment. In other words, principal and interest on the mortgage. They want to see 1.2%. That's what they want to see. Let's see. Floyd is saying, I suggest add $8,000 for emergency repair. Property is 80 years old. Amen to that, brother Floyd. So again, when I looked at this, guys, I went kind of light on expenses. There's actually a category you can use. It's a you're basically taking money. It's a capital expense account is what it is. You're taking money and you're putting it in an expense account that's to be used for capital expenditures. In other words, roofs, furnaces, big ticket items like that. And there are certain tax rules you can follow where you can, essentially, write off that say you put $50 a month in per month, you can write that off every year as an expense. The challenge is though, if you do have a capital expenditure in 5 years and you take that is you're going to add that to the cost basis of the property and you want to depreciate that, well, you then got to undo what you did in the prior years when you took that expense. Now, another thing you can do is, and please remember this, I'm not a tax accountant, I'm not a tax attorney, but there's a tax rule called 172, and I know investors who will apply that tax rule to their investment properties. And the reason they justify it is when you buy rental properties within an LLC, it actually is a company. It's a company, right? And the company is allowed to use tax rule 172. What tax rule 172 does is it allows you to take a capital expenditure like a new roof, and instead of depreciating that over the life of the property, because you add it to the cost basis, what you can do is take the entire write-off in the year that you took the expense, called tax rule 172. Now, I've had tax accountants argue and debate on this, and here's what it comes down to. This is my interpretation. I'm not a tax attorney or a tax accountant. The one explanation that makes the most sense to me is this: if you own a property in your own name, you should not do tax rule 172 because the rental property is not like another business. It's a rental property. It's an actual home, right? And I disagree with that. I don't care if you own it in your own name or not. It's a business. When you own rental properties, man, it's a business. The answer is this though: set up an LLC to buy your rentals, put the rentals inside the LLC. The LLC itself is a company, and then voila, you can use tax rule 172. All right, so that's the scoop on that. Let's see here. Floyd also says, second, suggest material increase in property taxes, recal cash flow. Yeah, the property taxes, it's different everywhere you go, guys. I've been in over 650 cities and towns over the last 3.5 years. Some municipalities, some taxing authorities, usually at the county level, are very slow. You could buy a property and they won't raise your taxes for 5 years. They just use whatever they got on record. Other ones are really quick to move. Now some of them they're variable. On the low end properties, they don't really care so much. On the high end properties, if you buy $1 million property, they're going to come in and raise your millage, or excuse me, raise your property taxes right away. I've seen other municipalities, i.e. taxing authorities, use what's called a base year. Famous base year is 1962. For some reason, I see that a lot all around the country. And they assume that those values are fixed for the purposes of taxes. And what they do is they raise the millage rates in those areas. They don't change the values of the property. They assume everybody's agreed on the value of the properties. Let's just change the millage, how much percentage you're going to charge on property taxes. I've seen that done before. I've also seen them use a ratio, like it's 25% of the value of the property, right? The tax is based on 25% of the value of the property. Why they do that, I have no idea. Makes absolutely no sense. But the reality is they're all different. And when you buy a property, Floyd's right, you should assume at some point your property taxes are going to go up. So good call, Floyd. Okay, let's look at these other. I'm going to reduce my panel so I can look at these other tables with you guys, and then we're going to have to wrap things up here. don't know why that table does that whenever I open up a new table. So here we go. Yearly financial projections. Okay, so you got your rental income coming in. First year, you're bringing in about 30 grand. Year 5, you're bringing in about 20% more, 36 grand. Not too shabby. You got your rental expenses. You got interest on your loan. You got taxes. You got insurance. Okay. You've got maintenance and repairs. You got the initial buying cost. Total rental expense has gone up in the first year from 36,000. Oh, I'm sorry, that's because you had your initial acquisition costs, right? So you take out the 10 grand, you ended up with starting off with 26,000, roughly speaking. And it's about 25, 26, you know, it fluctuates right around 26 grand over the ownership of the property. So your net income starts off negative, of course, but each year you make a little bit more, a little bit more, a little bit more. 5th year you make 10 grand, pretty good, right? Because on a percentage basis, see, that's the thing I love about rentals is everything. It's sort of like compounding, like interest does on a CD. End of the year, you netted 25 grand rents in your pocket, cash flow. Now you got to factor in your depreciation, right? And then you look at your taxable income. Remember, I said we had to factor in, we had to recapture depreciation, right? So you got taxable income is minus throughout the whole thing there. Tax benefit is minus 4,500 at the end of the day when you add all that up. Okay, you reduced your principal balance by a total of 27,800 over the 5-year period. Okay, so your net cash flow is $2,000, right? Remember, that doesn't factor in the sale. That's just straight cash in your pocket on a monthly basis. Okay, return on investment. Here's what most people want to focus on because it gives you dollars and percentages, right? So first things first, your initial investment doesn't change. It's 37,290 no matter what. It stays, it's static. You've paid in the initial purchase, and that's what you put down. All right, your yearly appreciation, you can see the property goes up in value each year for 5 years, and each year it goes up a little bit more. It starts off going up about 17 grand. Year 5, it goes up about 20 grand. All right, appreciation net of expenses. Okay, so you net your net of taxes. You take the taxes out of that. And that's what you end up with. And then you have your net cash flow. And there you go. Negative in the first year because your cost of your acquisition cost is factored in. But every year thereafter, you start to turn a wee bit of a profit. And you can see it does go up, not quite exponentially, but you know, quite frankly, it goes up, at least algebraically, right? Your net worth increase, each year it goes up, right? Remember the first year you got to factor in the acquisition cost, but every year thereafter, it goes up and up and up. And here's the final lowdown on this table, the ROI table, is your ROI, your what you've added to your net worth. Look at that, 58.9%. Not too shabby on a $39,000 investment, right? So at the end of the year, we still got to factor in the loan information. So let's go down and see what happens to our loan after all that. So initially we had a loan of 300,000, 301 to be exact. At the end of year 5, we paid it all the way down to 273. Right? Interest each year has gone down a wee bit, and the principal portion that we paid off has gone up a wee bit. At the end of the year, these are our mortgage payments. We paid that much each year. We paid $17,496 each year in mortgage payments. At the end of the day, guys, this is one really important figure, your ROI. Okay, and you also want to look at your cash proceeds on a sale after taxes, right? And then you remember, in 5 years you turn 39,000 into 93,000, and you've already accounted for the taxes on that. You see why when I do this, it makes me think twice about properties. I looked at the rental property calculator, the Excel spreadsheet, and I'm thinking this looks pretty weak. When I look at the online calculator where it does projections, I'm thinking, hey, who wouldn't want to turn 39,000 into 93,000 after tax in 5 years? I mean, most people would say, yeah, give me some of that. But this is why we use it, because in areas like New York City, like Toronto, like Vancouver, San Francisco, some of the really expensive areas, we need to use these calculators to show our clients how they can profit from real estate, even though on the surface it might look weak like this. All right. So let's do this, guys. That's what I wanted to show you tonight. It's not so much, I know I can teach you these calculators pretty quickly, but I like to use examples, real world examples in today's environment from you guys. Okay, I just wish Vassal was online with us. You know, we've had a different subject to cover next week, and the following week I'll be on vacation. But in any case, I love doing this. We did one of these back in July for Kate Crowell. It was on a flip. And so we had the opportunity to do a duplex. I thought, let's take the opportunity. Okay, let's see here. I don't see any questions. So it looks like we're all caught up. And that's good. So let's do this. For next week, guys, we are meeting next Wednesday. Same bat time, same bat channel. That's 7 p.m. Eastern. Next Wednesday, August 22nd. For those of you who are coming to New Jersey for the 3-day event, again, that's next Friday the 24th, Saturday the 25th, and Sunday the 26th for a half a day. Congratulations for making the stretch. I know we have a lot of New Jerseyans going to be there, and some folks from Pennsylvania and New York will be there also, of course. But everybody's welcome. We do have people coming in from different parts of the country. I look forward to seeing you all. Come ready to learn and earn and network. We're continuing to improve that whole event. So far, it's been an absolute grand slam home run for everybody. I mean, the feedback's just been 100% phenomenal. And I'll give you a big tip here. We actually have one coming up at the end of September, another one end of first weekend in November in Chicago. In any case, but come to New Jersey. Come see why they call it the Garden State. A lot of people, you know, it's funny. I've had people say, well, why would I go to New Jersey? I'm like, you probably should come here and check it out because it's mostly a beautiful state. There is the industrial area, you know, from New York City, but you go in 10 miles, man, it's phenomenally beautiful. For all the New Jersey folks, give me some feedback here. How do you like New Jersey, southern New Jersey, Jersey Shore? And then you go up into the hills and the mountains of New Jersey. A lot of people don't even realize New Jersey has mountains. You know, it's just a lot to offer here, and that's unfortunately a lot of people miss that. And I'm just blessed because I've been able to be here before on several occasions, and I've been able to experience a lot of this. So kind of a neat place. Okay, real quick, we do have one more question. Hang on, I almost missed this one. All right, would you still make the investment if there was only a 20,000 increase? Yeah, I'm looking for, so Floyd, good question. So for me, if I can double my money in 5 years, I'll likely do it. I want to do more than that. I want to more than double my money. But, you know, doubling my money in 5 years means my net return, my actual cash on cash return, my net return is going to be somewhere around 15%. And in today's market, I'll take 15%. The hurdle rate, by the way, since you mentioned that, if we use the stock market as a hurdle rate, obviously in the last year, it's been last year and a half, almost 2 years, it's been phenomenal, right? Ever since January of, well, probably late 2016, you know, once the election was over and people knew what they were dealing with, the stock market's gone up dramatically. Even though it teetered and level off, it's back on track again. So that hurdle rate is pretty, you know, pretty substantial. I mean, you're talking about you know, 30–40% hurdle rate. That's hard to overcome. But the thing is, that hurdle rate is not as reliable as an investment in real estate. Okay, it's very volatile. So reality is over time, I would like to use 10% is my hurdle rate. And so that's why I like doubling my money in 5 years, because that means if you do the math on it, I made a 15% return. So that's my answer to that. I actually shoot for a 20% return, Floyd. That's usually my benchmark, but it just depends on the marketplace and what the economy is doing in that marketplace, you know. Excellent question, by the way. Okay, guys, so this is being recorded. You all get the recording the next day. Oh, Vivica, hang on, let's see. When are holding an event in Atlanta area? So Vivica, we just did the one at the end of June in Atlanta. But you know what? Be willing to travel. I tell you what, man. You know, from Atlanta, you could hop on 85 all the way up to 95 in south of Richmond, Virginia, and then you're really only a couple hours from New Jersey and New York. You know, you should, if you can't come to New Jersey, come to New York at the end of last weekend of September. Beautiful place north of the Bronx, near White Plains. It's unbelievably beautiful. You can't even imagine it's that close to New York City. Chicago's a lot of fun. Let's see, to hear Jersey Girl all the way. Hate to hear it. You know what? You know, obviously lots of songs about Jersey girls, and I can tell you, when I went to college, I was in Virginia. We had a lot of people come down from New Jersey to go to school in Virginia, probably because it was a lot less expensive, and we had the ocean right there. It was at Virginia Beach in Norfolk, and I forget the song about Jersey girls. Maybe it was Bruce Springsteen. I don't know, but I got to tell you, every girl I've ever met from New Jersey was absolute, just fun, pleasant to be around, made you feel like a king, and just friendly. I just a lot of great times. Some of my best friends were in New Jersey. I stay with them a lot when I go to the Jersey Shore. You know, great hosts and hostesses, and a lot of fun to be around. Great kids too. So I appreciate your comments, and you're absolutely spot on. Okay, question. Can't make it to the workshop going to South Carolina. Can I give my ticket away? Tira, save it. Save it and go to the one up in just described up in New York. It's going to be I wonder if I got the location here. Yeah, it's in Tarrytown. It's essentially southeast of White Plains. It's about equal distance between White Plains and the Bronx, up along the water line. And you should see the scenery there. If you've ever been there before, you know it's a beautiful part of the country. But go to that one. You can go to that one, okay? I think you can give your ticket to the New Jersey one to someone else, but we want to make sure, if you do that, make sure you let Beverly know, and then we'll just see you at the New York one. Okay, I'm from New York and lived in the Bronx for years. I will do my best to get there. That is Vivica. Okay, Vivica. Yeah, it's actually north of there, Tarrytown. You probably know where I'm talking about. Tom Slaterbeck says New Jersey rocks. I agree with you, Tom. In fact, I'm kind of sad. Next week's my last week in New Jersey. Of course, I'll be right over the river in New York for the next month. But in any case, guys, this was a lot of fun tonight. I love doing these what if scenarios with these properties, because quite frankly, that's where we get the exercise, the tools, and get you guys to see how you can use these to help you get more deals and convince your clients that, hey, don't just look at the pie two-dimensionally, look at the pie three-dimensionally, slice it so you get 8 slices and not 4 slices. And you'll find yourself getting more offers accepted, okay? More offers made. So anyways, God bless you all. Hope you have an awesome rest of the week. We will see you on next week's webinar, which is Wednesday. And then also for those of you who come to New Jersey, we'll see you there. All right, take care. God bless. We will see you next week. Bye-bye, guys.